Hi, today I'm here with Rob Burns, Director at Hazelwood's LLP, talking about financial due diligence. And one thing I wanted to talk to you about, Rob, was is there a difference in the level of due diligence if you have a share sale or an asset sale?
Yeah, thanks, Leah. No, there absolutely is. I think generally there's two main types of transaction structures, share purchase, trade and asset purchase. A buyer would want to go into a bit more depth should they be going down the share purchase route. I guess in summary, what the buyer would be doing in that case is taking on the whole tax history of that entity. So naturally they would want a bit more insight, not just on the tax side of things, but are there any other liabilities on the balance sheet that could come up and bite later, any skeletons in the closet, so to speak. Whereas on the flip side of that, if a buyer's looking at a trade and asset, and that could be an unincorporated business, or it could be the trade within a company, and they're just acquiring one nursery and the seller's retaining the rest. In that instance, the buyer isn't taking on anything in terms of the history of that business. It's merely acquiring the trade and the assets. So on that base, limited input on balance sheet, I would say, probably just to the extent that they'd want to understand the working capital cycle. But as far as tax DD goes, not needed. You're not taking on any tax history, or any liability will remain with the sellers in that instance. So I would say focus on a trade and asset transaction would really be around the sustainability and quality of earnings, and are those earnings representative of likely future earnings? That would be the focus there.
And so with a limited company, so as a seller of a limited company, you have to be prepared that actually there will be a deeper dive into the finances, especially looking at things like taxes, because actually that's the sort of thing that if there is a problem with HMRC, they can come back to you many years later, or come back to the limited company many years later.
Exactly, and that's the risk that the buyer would be taking on. They don't want to be on the hook for a legacy tax liability. So I think in those instances, it would be highly recommended that sellers work with their brokers, their accountants, to really assist with that data collation. There is a lot of, it is overwhelming, particularly a first-time buyer who perhaps it's a foreign process for them. Lots of questions about your business, tax affairs. It can come across as quite accusatory.
A little bit,
but it's really not. It's just the buyer really just wanting to understand what they're taking on. We would work with both parties to make sure that the buyer gets that level of comfort. And
that's the key thing, isn't it? It keeps coming back to, it's about working with your accountant, your solicitor, your broker, your FDD guy, to make sure that actually everyone's working together to get the information.
Absolutely.
And making it as easy as possible for the seller as well, while still making sure that everyone's moving towards the end of the transaction.
Yes, absolutely.
I hope you found that useful. If you have any questions, please do drop them in the comments below, and we'll see you again soon.